Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by Notebook LM AI, this series brings you clear, meaningful insights into finance and beyond.
In episode 45, we dive into Lyn Alden's gripping framework of Nothing Stops This Train, a hard-hitting analysis of America's fiscal trajectory. With federal deficits locked in at 6 to 8% annually, Social Security running dry by 2035, and the Fed stuck in a trap where rate hikes fuel the problem, we're witnessing the rise of fiscal dominance. This isn't just about debt, it's about an economic structure running on unsustainable momentum. Tune in to uncover why the only way forward may be inflation, currency debasement, and a flight to scarce assets like Bitcoin.
Okay, let's dive in. There's this phrase, nothing stops this train. It's quite a striking image.
It really is. And it comes from one of the sources we looked at, describing the current state of U.S. fiscal deficits.
Right. So our topic today, America's finances. We're talking government spending, deficits, the national debt, and we've got these sources essentially arguing that this spending, these deficits, well, they're on an unstoppable path. Doesn't matter who's in charge, apparently.
Yeah, the argument is it inevitably leads towards, inflation or devaluing the currency. That's the core idea.
So our mission here is to really unpack those arguments. We want to understand why they think this fiscal train can't be stopped, the dynamics involved, and what they see as the consequences. The aim is to help you get a solid grasp of this specific and, let's be honest, pretty concerning viewpoint.
Definitely. And to get their perspective, you have to see what they call a fundamental shift. See, historically, U.S. deficits usually ballooned when the economy was weak, right?
Yeah.
Like during recessions, high unemployment.
Tax revenues fall, spending goes up. Makes sense.
Exactly. And then when the economy recovered, unemployment low, deficits would shrink. There was this predictable correlation.
But that's changed.
That's what the sources argue. A big break, starting around 2017 or so, we started seeing really high deficits, like 6 to 8% of GDP, even with low unemployment.
Huh. So the link is broken.
Yeah, they call it a decoupling. It's not the old pattern. It's a new era. Some sources label it fiscal dominance.
Okay, so if the old rules are out, why is this train supposedly unstoppable? What's the first big reason they give?
Well, the first reason is pretty stark. They argue the economy itself has become dependent on this constant high level of government spending and these deficits.
Dependent how?
The idea is if you tried to suddenly pull back, cut spending significantly, the sources argue the shock would be huge. Asset prices crashing, unemployment soaring.
Which would hit tax revenues.
Exactly. Tax revenues would collapse and kind of ironically, the deficit might actually get worse.
Wow. So hitting the brakes doesn't slow things down smoothly.
No.
It triggers a crash, derails the train.
That's the analogy, yeah. It's the opposite of a soft landing. The system, as they describe it, needs this fuel just to keep running. Cutting it off becomes self-defeating.
Okay, so the economy needs the spending, according to this view. But surely we still have the Fed raising interest rates. That's the classic way to cool things down, right?
That is the traditional playbook, absolutely. But the sources argue that even that tool, it doesn't work like it used to. That's the second reason the brakes are, broken. Well, think about the debt level. Federal debt is over 100% of GDP now. One source mentioned over 120%. It's massive. So when the Fed raises interest rates, yes, it might slow down private borrowing a bit, but it massively increases the government's own interest payments on all that existing debt.
So the government's interest bill goes through the roof.
Precisely. So the irony is tighter monetary policy, higher rates actually makes the federal deficit worse. The interest expense just explodes.
You're kidding. So stepping on the monetary brake pedal actually feeds the fiscal engine more gas. It's like backwards.
Exactly. They use terms like through the looking glass or wonderland. The old rules work in reverse.
Yeah.
The very action meant to slow things down ends up making the government need to borrow even more. It's a feedback loop.
Okay, that's quite a twist. So, reason 1, economic dependency. Reason 2, broken monetary brakes. What's the third big driver they highlight? Sounds like it's more about demographics.
Yeah, this one feels very concrete, almost mathematical. It's demographics and entitlements. The big factor is the baby boomer generation retiring.
Okay, that's been talked about for years.
Right, but it's happening now. The sources point specifically to the Social Security Trust Fund, about $3 trillion. It's currently being spent down. The math, The actuarial projections cited suggest it'll be empty around 2035.
And fixing that is politically difficult.
Extremely. The sources argue it's basically off the table politically. Both parties have largely pledged not to touch Social Security benefits significantly. Why? Because older Americans vote in huge numbers.
Right.
So these outflows, they're just baked in. They're set to grow regardless of election outcomes. It's presented as pretty much set in stone, driving deficits higher.
Locked in spending. Feels very hard to stop that train. Okay, what about the engine of economic growth itself? Has that changed?
Yes, that's their fourth major point. For decades, economic growth was largely fueled by the private sector taking on debt. Bank loans, corporate bonds.
Businesses expanding, people buying houses.
Exactly. Private credit growth was the main engine. But the argument is, since the 2008 crisis, that's fundamentally shifted. And it's, permanent.
How so?
Federal debt, government borrowing has effectively become the primary engine driving growth.
And why the switch?
Well, the reasoning is the private sector households, companies, they're already heavily leveraged. Capped out, you might say. There's just limited capacity for them to borrow massively more, not on the scale needed to drive the whole economy forward like before.
Okay, so if the private sector can't borrow much more, the only player left who can borrow on that scale is?
The federal government. That's the argument. It becomes the borrower not just of last resort for crises, but the borrower for basic growth.
Which leads us into the fifth reason, and this is where the language gets pretty intense. They talk about a Ponzi nature. Lack of an off switch? What's that about?
Yeah, they argue the system, just how it's built, requires constant growth to even function. Like a shark, It has to keep swimming or it sinks.
Constant growth of debt.
Essentially, yes. They point to the sheer numbers. Total debt in the system, public and private, over $100 trillion. Compare that to the monetary base, the actual underlying central bank money, maybe $6 trillion. That's huge leverage, like 17 to 1 now.
And it was even higher before.
Oh yeah, it peaked near 50 to 1 back in 2008. And when the system buckled then, under that strain, the response wasn't really deleveraging, not shrinking the debt. It was, as the sources put it, acceleration. Zero interest rates, QE, quantitative easing, printing money to buy bonds, and now these huge deficits. Total debt actually only dipped for a tiny moment in 2008, like 1%, before they hit the accelerator hard to prevent a total collapse by expanding the base.
And there's historical data on this, right? That debt almost never shrinks.
That's a key point they make. In over 110 years of data, total debt has only actually decreased in 5 years.
5 years out of 110.
Yep, 4 during the absolute worst of the Great Depression and that 1 year, 2008. They argued this shows the system has virtually zero tolerance for shrinking, for actual deleveraging.
So the argument is the system can't handle contraction. It has to keep expanding the debt.
It can only inflate the debt away. That's the conclusion they draw. The structure, things like fractional reserve banking, it just inherently creates debt that needs more debt to sustain it. The only way out, the error correction as they call it, isn't fixing the debt level. It's just creating more money or credit, printing, basically.
Okay, so let's put it all together. If you can't pay off the debt without crashing the economy, and you can't really use interest rates to slow things down because that makes the government's own debt problem worse.
Yeah.
What's the only path left, according to these sources?
Well, given those constraints, they conclude the only path is inflation. You inflate the debt away.
How does that work exactly?
It means keeping interest rates relatively lower than inflation and lower than what would be needed to truly stabilize the debt. You let inflation run hotter than interest rates. Over time, this erodes the real value of the outstanding debt. The dollars you pay back are worth less than the dollars you borrowed.
So it's a quiet default almost? Devaluing the currency?
That's one way to look at it. They contrast this with the last few decades where interest rates were generally falling, which helped manage rising debt. But now debt is so high, even kind of moderate rates create a huge interest expense problem. It's a different world.
They compared it to the 1940s.
Yeah, they draw a parallel. Back then, you had private debt issues, rates hit zero, and the government took over as the growth engine during and after the war. That massive war debt was ultimately inflated away over the following decades.
Okay, so if this is the outlook, ongoing deficits, inflationary pressures, a system needing constant fuel, what does this mean for, people's investments? That's a huge focus. They argue it has profound implications, especially for assets that are scarce, things that can't just be printed or created easily,
Like gold?
Gold is the classic example. They discuss the historical link between gold and real interest rates. That's interest rates after accounting for inflation. Traditionally, if real rates were high, savers got a good return, so gold wasn't as attractive. If real rates were low or negative, gold looked better as a store of value.
Makes sense. But you mentioned something changed recently, around 2022.
Yes, one source highlights a decoupling. Since about 2022, gold has performed really well, even soared at times, despite real interest rates rising.
So the old relationship broke down. It seems like it. To them, this suggests something else, something bigger is driving things now. And that bigger thing, they argue, is this whole fiscal dominance story, the unstoppable train.
And this is where Bitcoin comes into their analysis.
Exactly. They really challenged the narrative that Bitcoin was just a zero interest rate phenomenon, only valuable when money was free. They point out that recently the Fed was incredibly aggressive, hawkish, raising rates fast, even breaking some banks.
Right, Silicon Valley Bank and others.
Yeah. And yet, during that high-rate stress period, both gold and Bitcoin didn't collapse. They actually soared.
So Bitcoin doing well when rates were high suggests it's not just about cheap money.
That's their interpretation. They see it as evidence that the underlying fiscal situation, the unstoppable deficits, the need to inflate, is a more powerful driver than just the Fed's interest rate policy.
So the rational move, in their view,
is to own assets that are outside that system.
Yeah.
Assets that can't be debased or diluted when the government needs to create more currency or credit.
Gold has been that historically. Why Bitcoin specifically?
Well, they see gold as having limitations. Bitcoin, they argue, is potentially better suited for this digital age. It's easily portable, it's programmable, and crucially, it has absolute mathematically enforced scarcity, something gold doesn't quite have set. You can always mine more gold. Bitcoin's supply is fixed and known.
So they see it as like the ultimate hard asset for this environment, the mirror image of the flexible fiat system.
That's the framing, a system built on a flexible ledger, where you can always add more units, versus Bitcoin's fixed, transparent ledger.
And that's why they think it's thriving now. Even with 5% interest rates available elsewhere, it's a bet against the future value of the dollar, driven by these fiscal issues, an embrace of sound money.
That seems to be the core argument, yes. In a world where the main currency is expected to lose value over time due to these unstoppable pressures, something with a truly fixed supply becomes very attractive to some people.
Okay, so let's just quickly recap the main pillars of this unstoppable train argument from the sources.
Sure. Two big categories, really. First, it's systemic, almost mathematical. The sheer size of the debt, the structure of fiat and fractional reserve banking, it just requires constant expansion. Deleveraging is too painful, so the default is always to create more units.
The mass of the system.
Right. And second, it's human nature, politics. Nobody really wants higher taxes. Nobody getting government benefits wants cuts. Politicians respond to those incentives. Making truly deep, painful cuts is rarely a winning strategy in the short term.
And the contrast with Bitcoin again
is that Bitcoin is designed differently. Absolute scarcity, transparency, and a way to handle adjustments, like deleveraging, without needing to debase the actual unit, the Bitcoin itself. Fixed ledger versus flexible ledger.
And the time frame they see this playing out over, this unstoppable phase.
The analysis suggests this path, these kinds of deficits around, say, 7% of GDP, is likely locked in for at least the next 10 years. It doesn't mean nothing ever changes, but they don't see any force strong enough on the horizon to meaningfully alter this trajectory soon. The train keeps rolling, maybe speeds up or slows down a bit, but doesn't stop.
Right. So, wrapping up this deep dive, the core message from these sources is stark. The U.S. fiscal path looks like an unstoppable train, driven by the economy needing the deficits, monetary policy breaks not working right, the math of demographics, federal debt becoming the main growth engine, and the basic structure of the financial system itself.
And the main outcome predicted from this view: ongoing high deficits leading inevitably to more inflation and a devalued currency over time, which leads them straight to the idea that scarce assets, things like gold, and particularly Bitcoin with its digital scarcity, could be really important hedges in this kind of environment.
So understanding this perspective, even if you don't fully agree with it, is pretty valuable as you navigate what's happening and think about the future. It's one distinct view drawn from the material we reviewed. And it leaves us with a big thought for you to mull over. If this analysis is even partly right, if the system really struggles with deleveraging and the path of least resistance is inflation, what does that really mean for how you think about saving, investing, and value over the long haul? And maybe more fundamentally, given the roles of math and political incentives described here, is there any realistic way within our current system to actually change this trajectory significantly? Something to think about.